All right, it is Tuesday, September 12th, 2023, and today I am going to put on a regular weekly 112 bear trap, looking for a 52 days until expiration cycle. It is November 3rd, 52 days away. S&P is currently trading at 44.78. I'm going to structure this trade very similar to what I normally do, except I'm going to go with a 40-point wide put debit spread. And by going 40 wide instead of going 50 wide, I'm paying a little bit less of a debit for my put debit spread. And because I'm paying a little less for my put debit spread, I can push my out of the money naked puts a little bit further out of the money, right? So if I, let's say, paid $10.75 for a 50-point wide put debit spread, I would have to place my short naked puts 25 points higher than if I did a 40-point wide for about $9.85 or so. And that allows me to push my naked short puts farther out of the money. The reason why I'm doing that is because volatility is relatively low, and I don't really want to sell naked puts closer at the money, or at the very least, I would try to figure out a way that will allow me to put my naked shorts as far out of the money as possible. So if I'm paying less for a put debit spread, that means I could potentially collect less from the sale of my naked short puts. And if I am collecting less for the sale of the short naked puts, that means my naked puts could be farther out of the money. I hope that makes sense. So my strikes here are the 40-point wide put debit spread is at 44.40, 4400. And let's have a look what this put is going for, or put debit spread rather. So this put debit spread is going for about $10.40. So normally I would have to sell. So if I'm paying $10.40 for my put debit spread, now I'm looking for a short put to sell for about the same as the cost of the put debit spread. So the put debit spread is currently going for $10.40. I have a 40.50 that's going for $10.95, and a 40.25 that's going for $10. Right? So there is nothing in between, but if we did have something in between, maybe we would have found a put that is going for, or as close to, $10.40 as possible. Well, that's okay. So I am looking to sell a 40.25, and I'm going to sell two of those for every one put debit spread. That creates a 1-1-2. We have one long put at 44.40 with one short put at 4,400. Right, that's 1-1, and then we have two naked puts at 40.25. That makes it a 1-1-2. This trade is currently going for about $9.60 credit, maybe $9.50 credit. We want to collect as much as we possibly can. So we'd start this trade with $9.80 is what we're seeing right now. Now it's $9.75. So the price is going to fluctuate. We don't know where the market is, but our goal is try to collect as much credit as possible. So I would start with $9.80. If there's no fill after a couple of minutes, maybe I'll work my way down to $9.70, $9.60, down to about $9.50. I would probably work this trade down to as low as $9. And if there's nothing that fills under $9, or if there are no fills for $9 or higher, I wouldn't continue to drop my price. I would probably look to shift my either put debit spread a little bit lower, right, which would make it a little bit cheaper, which means I would collect a little bit more money up front, or I would have to look to move my naked puts a little bit closer to at the money. And a little bit closer there is no little bit. There are 25-point differences between all these strikes, so I would have to move my naked short puts about 25 points higher. Not ideal, but it is what it is. So that's my trade. 4440, 4400 put debit spread, financed by a sale of 2 of the 4025. I'm looking to collect around $9.50. That's where this mid price is currently showing here. And let's just talk real quick about the potential outcomes. Outcome number 1, the price goes higher. S&P goes higher towards 4,700. At expiration, all we get to keep is the credit that we're going to collect up front, because all of our options are going to expire worthless. Put debit spread is going to expire worthless. Short naked puts are going to expire worthless. We get to keep what we collect up front. That is scenario number 1. Scenario number 2, we are inside the trap. This is the best case scenario. We have a 40-point wide put debit spread that's going to be worth 40 points or $4,000 per one contract plus $950. So this trade has a max potential reward inside the trap close to $5,000 or close to 50 points. Right? We get 40 points from the put debit spread and we get about $9.50. So $49.50 inside the trap. The trap is between the long leg of the put debit spread and the naked short puts. Say in scenario number 3, this is not what we want to think about, but we have to think about this. We probably should have started with this. But scenario number 3 is that the price tanks and we get stopped out. Now, what I use for my stop loss, if I know that max potential reward in this trade somewhere around $5,000, I don't want to risk too much more than what I could potentially make inside the trap. So if I'm down about $5,000 per one contract in this trade, that is my cue to get out. Unwind this trade, meaning I'm going to sell to close the put debit spread, and I'm going to buy to close the naked short puts. One thing I'm going to do at some point in the future, when and if the short naked puts are going to lose about 90% of their value, I'm going to buy to close these puts, leaving the put debit spread open, and that is going to serve as a hedge for some of the newer trades that I'm going to open in the future. All right, so that's the trade. We have a plan. Stop out if this trade is down about $5,000 per one contract. If the price runs away to the upside, we'll get to keep the credit up front, and best case scenario, maybe the price will go up and down, and eventually it'll make its way into the trap sometime, maybe 45 or 50 days from today, and then that's going to be the trap profit bonus. All right, until next time, trade and well.